Hello, friends, and welcome back to Boss Economics World, the only place that tells you not just what's in the financial news, but why it's a symptom of a much deeper, much more profitable, and much more terrifying disease. So, today, September 9th, 2025, the champagne corks are popping for anyone holding that shiny, yellow, prehistoric metal. Gold just punched through $3,600 an ounce like it was wet tissue paper, setting another all-time high. The mainstream narrative, dutifully parroted by every financial news intern from New York to London, is simple: oh, the US job numbers were weak, so the Fed is going to cut rates. Lower rates make gold, which pays no interest, look sexy again. Buy. And while that's not wrong, it's like describing a tsunami as a bit of a big wave. It's a dangerously simplistic sedative designed to keep you calm while the foundations of the house are being washed away. Today, we're going to peel back this onion. We're going to go from the surface-level noise to the tectonic plates grinding beneath the global economy. Because this gold rush isn't a vote for gold. It's a massive, flashing, neon-lit vote of no confidence in everything else. Let's break it down. The immediate trigger, the headline you're reading, is the expectation of Federal Reserve rate cuts. Friday's payrolls report was a dud. The market expected, let's say, a respectable 180,000 new jobs. Instead, the Bureau of Labor Statistics coughed up a measly 50,000. The unemployment rate ticked up to 4.5%. Now, in a sane world, this would be bad news. A weakening economy, fewer people working. But we don't live in a sane world, do we? We live in a world where the only thing that matters is the flow of cheap money from the central bank. Bad news for the economy is now fantastic news for Wall Street, because it means the Fed, our high priest of monetary policy, is about to open the liquidity spigots again. Traders are now pricing in a 90% chance of a rate cut next week. They're not just predicting one cut, they're betting on 3 by year-end. This is the Pavlovian response perfected since 2008, economy sick? Ring the bell, and Jerome Powell will come out with a bowl of delicious, freshly printed money. And in this environment, holding a U.S. Treasury bond that might soon yield a pathetic 2% or 3% while inflation is still stubbornly running hot looks like a sucker's bet. Why hold a piece of government paper that is guaranteed to lose purchasing power when you can hold a 5,000-year-old rock that the Fed can't print? This is the official story. It's neat, it's tidy, and it completely misses the point. It's the smokescreen. The real fire is burning much, much deeper. Let's talk about who is really buying this gold. Yes, ETFs are seeing inflows. The little guys, the retail gold bugs, are piling in. But they are a drop in the bucket. The real whales moving this market aren't in their basements polishing their gold bars. They are in the treasuries of Beijing, Moscow, New Delhi, Ankara, and Riyadh. For the last 3 years, the single biggest buyers of gold, by a landslide, have been central banks. Let's look at the numbers. The World Gold Council's Q2 2025 report shows a staggering trend. Central banks collectively added over 300 metric tons to their reserves in a single quarter. For context, that's more than the entire annual mining output of South Africa. This isn't a new trend, it's a dramatic acceleration of a movement that started over a decade ago but went into hyperdrive after 2022. Why? 2 words: weaponization of the dollar. When the US and its allies froze Russia's foreign currency reserves in 2022, it sent a shockwave through every non-Western finance ministry on the planet. The message was clear: the US dollar system, the very bedrock of global finance for 80 years, is no longer neutral territory. It is a tool of American foreign policy. If you fall out of line, your access to your own national savings can be cut off with the flip of a switch. Suddenly, holding trillions in US Treasury bonds didn't look like a safe, responsible strategy. It looked like a potential liability. It looked like you were storing your national wealth in your rival's vault, and he had the only key. So, what do? You quietly, methodically, begin to swap those digital dollars and US government IOUs for something physical, something apolitical, something that sits in your own vaults. You buy gold. Look at the data from the People's Bank of China. They've officially reported buying gold for 22 consecutive months. And that's just what they admit to. Most analysts believe their actual holdings are orders of magnitude higher. It's not just China. India, Turkey, Poland, Brazil, the UAE, the entire BRICS Plus coalition and their allies are on a historic buying spree. They are not buying gold because they expect a 25 basis point Fed cut next week. They are buying gold because they are building an alternative financial system, a plan before a world where the dollar is no longer the undisputed king. This gold rally isn't speculation, it's a geopolitical paradigm shift playing out in real time. It's the slow, methodical construction of a monetary lifeboat by nations who see icebergs on the horizon. Now we get to the heart of the matter. The real, terrifying reason why gold is at $3,600 and heading, as Goldman Sachs predicts, to $5,000 and beyond. It's the number you see right behind me, $39.8 trillion. That is the current US national debt. Let's just round it up to $40 trillion, because we'll be there by Christmas. This number is no longer just an abstract figure. It is a mathematical trap from which there is no escape. The Federal Reserve is not cutting rates because the economy is a little weak. The Federal Reserve is being forced to prepare for rate cuts because the interest on this debt is about to bankrupt the United States government. Do the math with me. It's shockingly simple. A few years ago, when rates were near zero, servicing this debt was manageable. But after the historic inflation of the early 2020s, the Fed was forced to hike rates to over 5%. As old, low-interest debt matures, the Treasury has to refinance it at these new, higher rates. Today, the blended interest rate on that nearly $40 trillion of debt is climbing past 3.5%. That means the US government is paying nearly $1.4 trillion per year just in interest payments. That's more than the entire national defense budget. It's more than Medicare. It is the single largest line item in the budget, and it produces nothing. It is a deadweight loss, a tribute paid to the bond market. Now, imagine if the Fed tried to be fiscally responsible and keep rates at, say, 5% to truly kill inflation. The interest on the debt would rocket towards $2 trillion per year. The system would collapse. The government would have to default on its obligations either to its bondholders or to its citizens through Social Security and Medicare. This is the debt trap. The Fed's so-called independence, which President Trump has so publicly attacked, is a farce. The Fed is not independent. It has become a subservient arm of the US Treasury, and its primary mandate is no longer stable prices or full employment. Its primary, unspoken mandate is to ensure the government can afford its interest payments. And how do you do that? You have two choices. 1. Austerity, massively cut spending and raise taxes. Politically impossible. Suicidal for any party that attempts it. 2. Monetize the debt, suppress interest rates and print money. Let inflation run hot to devalue the real value of the debt over time. They will always choose option 2. Gold isn't just an inflation hedge anymore. It's a policy failure hedge. The market knows the Fed has no choice. They must cut rates. They must restart QE. They must inflate. It's not a choice, it's a mathematical certainty. And gold is simply the canary in the coal mine, singing its beautiful, terrifying song, telling us the air is getting toxic. Finally, let's talk about trust. The entire global financial system built after World War II was based on trust. Trust that the US would be a responsible steward of the world's reserve currency. Trust that the Federal Reserve was an independent, apolitical institution run by sober academics. Trust that a US Treasury bond was the safest asset on earth. Every pillar of that trust is crumbling. The COVID-19 pandemic and the subsequent response saw the Fed print more money in 2 years than it had in the previous century. That shattered the illusion of prudent monetary policy. The weaponization of the dollar against Russia shattered the illusion of the system's neutrality. And President Trump's constant, relentless attacks on the Fed, calling them idiots and demanding rate cuts for political gain, shattered the final, most important illusion, the Fed's independence. It revealed the quiet part out loud that the central bank is, and always has been, subject to immense political pressure. When you lose faith in the currency, the central bank, and the government's fiscal sanity, where do you go? For centuries, the answer has been the same. You go to the one asset that has no counterparty risk, no CEO, no board of directors, and no politician who can devalue it with a tweet. You go to gold. Look at the ETF holdings. The prompt mentions they are still below the peaks of COVID and the Russia-Ukraine war. That's the most bullish signal of all. It means the big, institutional money, the pension funds, the insurance companies, hasn't even really started to move yet. They still have most of their safe allocation in bonds. Goldman Sachs' prediction of $5,000 gold isn't based on some wild speculation. It's based on a simple portfolio calculation. The global bond market is a $130 trillion behemoth. The entire stock of above-ground gold is worth about $15 trillion. If just a tiny fraction, say 3 to 5%, of that bond money decides that government IOUs are no longer a safe haven and reallocates into gold, the price doesn't just rise, it goes parabolic. It's a fire exit door for a crowded theater. So, as you watch the price of gold tick higher, don't get distracted by the noise about a weak jobs report. That's not the story. The story is a group of powerful nations quietly exiting a financial system they no longer trust. The story is a US government caught in a debt spiral so massive that its own central bank has become its enabler, forced to print money to keep the country solvent. The story is a profound, systemic crisis of faith in the institutions that have governed the global economy for generations. Gold is not making you rich. It's simply preserving your purchasing power while the currencies of the world are being deliberately and systematically destroyed. The price of gold isn't going up, the value of the dollar, the euro, and the yen is going down. Gold is just the immutable yardstick measuring their decay. This isn't a party. It's a warning. Gold at $3,600 an ounce is the world's financial fever, and it's telling you that the patient, our global monetary system, is critically ill. Remember, in this game, the real profits are made by understanding the script while everyone else is just watching the movie. Don't just watch the price. Understand the forces behind it. That's all the time we have for today. Stay sharp, and don't believe the hype. Believe the math.